everybody, and welcome to our webcast. I am super excited to do this one today. I've been thinking about this since we started East Daley in particular, have been talking about gas markets and the collapse in gas markets and the growth of infrastructure and putting together decks and analysis for our clients. So this one I'm really excited about, and we've got two fabulous co-presenters today with me. So we'll do some quick introductions and then launch into the presentation. My name's Justin Carlson. I am the CCO of East Daley Analytics. We are a analytics organization connecting supply, demand, and profitability through infrastructure data and analytics. At the end of the day, we just love digging into the details and solving really hard market problems. So if you have one of those, we serve market analysts, who do a lot of the same things we do, but maybe don't have the time, don't have the resources, don't have, a lot of things in order to do as a thorough job as they really, really want to and are able to, or the decision makers who really want to move fast. So again, really excited to be on the call today, excited to talk about storage, and also excited to have my co-presenters here, and I'll let them introduce themselves. So Gary, why don't you kick us off?
All right. Thanks, Justin. My name is Gary Kruse, and I am the Managing Director of Research at ARBO. My undergraduate degree was in math, but then I spent over 30 years as a lawyer, including the last 8 as the general counsel for a FERC-regulated pipeline. I joined ARBO about 6 years ago. At ARBO, we transformed the vast repositories of unstructured public energy regulatory data into actionable business intelligence for the midstream sector, as well as commodity marketers and traders. Said differently, we focus on the details, a lot like Justin described, of the regulatory environment and its impact on energy businesses. And we support our customers with differing combinations of data, software, research, and consulting services. So with that, I'll throw it over to Edmund for his introduction quickly.
Thanks, Gary. Edmund Knolle. Also started life as a lawyer, but didn't do it as long as you did, Gary. I've been in the gas storage business since 1998, both with private equity-backed companies and a mid-sized public company. Currently working with Gulf Coast Midstream, a startup based in Houston, Texas. We've got a project, a gas storage project we're working on that I'll talk more about later. I'm also helping a machine learning company with a proven upstream technology to enhance reservoir storage performance. So look forward to the discussion. I got lots to learn, like we all do, about gas storage and the issues that are coming.
Awesome. Thank you, Edmund. I honestly, I didn't know that I was presenting with 2 lawyers. I'm going to have to check the company that I keep a little more closely. So let's jump into this. We've got a cool agenda for today. We're going to spend some time talking about U.S. supply demand dynamics. We're going to spend some time talking about a different paradigm, not intrinsic value, but extrinsic value of storage and what folks should be looking at going forward. Some storage profitability, the latest of what's happening, and then also get some commercial perspective, some regulatory stuff on what's happening in storage. So it's going to be a good agenda. We're going to try to plow through this. If you have questions, there's a question box down there at the bottom. You can ask them anonymously. We will answer them as best we can towards the end of the presentation. And then certainly if there's any that we miss or don't have time to follow up with, I'm sure the team will work to prioritize getting to you if we run out of time. So I always like to start this with something that we've been sharing with our clients, which is just sort of a build out of some of the major supply and demand dynamics impacting the decisions that we're making today and tomorrow and going forward. And this is a bit more of a, the maps is a bit more of a way to just put some context and framework around timelines and how this is all going to unfold. So the first portion of this that we like to talk about is this phase we're in now where we're going long and evaluating supply out of the Permian. How much will it fill PHP? How much will it fill Whistler? How do those pipelines that come down from Louisiana impact Haynesville production growth? But the general consensus that we came to, last year and have been continuing to talk about is the fact that we just have all this new infrastructure supporting the ability to supply markets going forward. That's not only out of the Permian and the Haynesville, but also we've got new stuff with El Camino and the Pelican Pipeline and EOG and really Webb County in the Eagle Ford that's supporting additional growth to feed, LNG demand in particular, which is the growth sector that that's going to be hitting us the strongest of all the demand sectors going forward. And all this pent up supply is sort of in advance of the coming LNG wave. Then we get this massive wave in 24 where we go even longer from a perspective of Matterhorn and incremental LNG capacity to serve those, incremental pipeline capacity to serve those LNG markets coming out of the Haynesville with NG3 and LEAP, the additional phases of LEAP and LA Energy Gateway and Williams project. So tons of new projects coming online to support the impending onslaught of demand, which at this point in 24 hasn't really come. We've got Golden Pass, great. We've got Plaquemines. I hope I said that right, Edmund. But those two facilities alone are about a little over 4 Bs, and yet all of this infrastructure that's coming online in advance of that, including the 3 from the Permian, the 6 from the 6.5 from the Haynesville, the 3 down in the Eagle Ford. I mean, that's 13 Bs of new capacity to serve supply, and yet we only have about 4 Bs of new demand. And then finally, you finally get this wave of new demand that comes online with all these LNG facilities. So this is that supply demand dynamic. But we're not here to really talk about supply demand. We're here to talk about storage. This just helps set up some of the problem or gives some magnitude of the problem as we look forward and see, well, what kind of levels of storage might we need to support this? So with that, I'm going to dive into a big portion of the supply push that's supporting that demand side is Permian and it's Haynesville. And you see that in the graph here on the right-hand side where you've got in blue the Permian growth, which as you can see ramps up and then just sort of tables out. We use the curve to inform our longer-term production forecasts. And that curve suggests that we're going to see lower rig counts in the future than we see today. The other thing to note about this is we don't expect or have built in a massive ramp in IP rates. I know EOG's talked about 20% better IP rates or product EURs. In fact, not IP rates necessarily, but EURs out of wells in the Permian for a portion of what they're doing. I mean, so there's some of that does exist. At the same time, we've also seen a bit of a flattening in the IP rates in the Delaware and the Midlands, so we're a little weary of that. The point of all of this, though, is that, again, we've got 10 Bs of new supply here between the Permian and the Haynesville in orange, and yet we've got over 18 Bs of potential new demand, which we'll explore the LNG side here in a minute. That then said, if that imbalance exists, we're going to need even more supply, and that's likely going to come from other basins. I talked about the Eagle Ford earlier, but Anadarko, Barnett, perhaps we get into the other parts of the drier gas parts of the Permian as well. And those are important increases that we're going to have to start to balance against demand fluctuations going forward, and not necessarily seasonal demand fluctuations as you might expect from, let's say, the extrinsic or the intrinsic value of storage, but the extrinsic value of storage, which is short-term fluctuations. The other thing to note about this is in order to incentivize those other basins to grow, we're going to need prices to go up. As prices go up, that brings more value into the storage equation than when prices are $2. If prices are $4 or $5, there's more value in the storage equation. So just from a perspective of the supply, that's where we see that we're headed. And as we go forward, now let's break this or pull this back towards evaluating storage. So what I have here, and to put some context on the graph, the bar chart, the bars on the right-hand side on that graph are our expected growth rates in demand. And what you can clearly see from that is the elephant in the room, and of course the gray bars at the top, which is the amount of LNG growth that's coming into the market. We'll dig into that in a bit, but note, that is the elephant in the room. If we go back in time and look at the red line, which is storage deliverability. Now, I intentionally did not use storage capacity at working gas capacity. And the reason that I didn't do that is because I view that as a bit more of the value of the intrinsic value of storage, which is how much can we put in the ground in the summer to then pull out of the ground in the winter to serve winter load. Well, we're not really talking about that right now, because what we're really talking about is how much can we adjust deliverability on a daily, weekly, monthly basis in terms of how much can we stick in the ground or pull out of the ground on a quick turn basis in order to support the volatility that might exist in the market. So that red line is where you see that growth in that withdrawal capacity is over the entire U.S. And the purple dotted line is the percent of demand that represents. So what this shows you is, of course, from 2005 to 2010, we built a ton of new storage in the U.S. primarily to support intrinsic value of storage, i.e. the summer-winter spreads. That peaked, and that was about 20 BCF, and that peaked at 150% of total deliverability as a percent of total demand. We kept building that through 2014, 15, where we ultimately peaked our deliverability as the red line, sort of tops out and tables out there. And then we didn't really build much of anything going forward. And to date, we don't have a lot of, we'll talk about this later, we don't have a lot of facilities on the expansions on the roadmap of what we're building out. So we were very early in the storage build out phase. By 2027, what's really fascinating, when we peaked at 150% of deliverability, we all of a sudden cratered or are expected to crater down to 90%. So from 150% to 90% is how far we will fall in terms of our ability to manage that daily, weekly, monthly sort of deliverability of storage. This, in fact, is a daily deliverability. So you can expect where that sits. So now we're going to take this macro view. And when you think about managing that volatility, one of the best facility types to manage that is salt. Salt is located in the Gulf. And so we'll step that back down into the Gulf. Just a quick overview of the Gulf. And you can see it here.
Justin, just real quick, I'd like to make just a couple of observations about your excellent chart here. One is, I guess, obvious from the chart. If you could flip back, is that we're now at a place well below the beginning of the last cycle of development. And we were building storage, redeveloping storage in that cycle. And I can tell you that every project that had been floating around, every prospect for storage development that had been floating around for a decade got developed during the 2000s. And then some. And there was some expansion left, and especially in salt, that wasn't and has been developed. But a lot of the good stuff was taken, most of it, in fact. And then why, just a couple of quick notes on, so why wasn't more built in the meantime? Shale is a huge part of that. I think you already mentioned that. Provide a lot of liquidity to traditional storage users, LDCs in particular, and based on no need for more storage, in fact, started letting go of storage capacity, as late as 2 years ago. That's all changed. All the LNG has come on in very large chunks in a very short period of time, and we live in a world where there's not a system-wide planner that's looking at LNG pipeline storage like if it were a fully integrated utility model. We live in a world where people focus on their particular part of the market, and they need contracts before they build anything. So there's a lag, and that explains a lot of why storage just hasn't gone anywhere in over a decade.
Yeah.
That's my comment.
Yeah.
Go ahead.
Yeah. Agreed, Edmund. It's a good comment because, again, I think that, as you mentioned, we built a lot of this capacity to serve that intrinsic value of storage in the summer winter load. Shale took a lot of that out, or the need for as much of that out of the equation. And I think going forward, we have to look at a new way to value storage and the usability of storage. And that's what we're going to dig into now, is some of the volatility that we need storage to manage going forward. I won't spend a lot of time on this. Some really good numbers here with respect to how much storage is in the Gulf. You can see about a third of the storage in the Gulf as we zoom down into the South Central region is defined by EIA. About a third of that is salt in terms of working gas capacity, but you'll note that about 2/3 of it, or almost over 60%, is in deliverability. So salt, while it represents a third of overall working capacity, it represents 2/3 of what we're able to deliver to the market and adjust to daily volatility. If you zoom in on Texas and Louisiana, and which takes out some of the constraints, pipeline constraints that may be present, that exist in the grid, and adapting when you consider Kansas and Oklahoma and those storage facilities in South Central region. Texas and Louisiana has more than half of those at almost 50 facilities down there. Again, predominantly, or a lot of which are going to be your salt facilities as well. So we'll now go and dig into the South Central region and just look at their deliverability. And their deliverability peaked at almost 200%. So at that point, it was exactly what Edmund was talking about earlier, which is 200% was to serve other markets, downstream markets in the Northeast predominantly, but the Midwest as well, as we were piping a lot of gas out. Shale, particularly growth in the Marcellus, changed a lot of that volatility. You didn't quite need that same level of adaptability, or that same level of responsiveness to serve downstream markets. And the question going forward is, what's the level of responsiveness that you need to serve local markets in the South Central region, as we get LNG, which could grows from where it is today to even up to 30 BCF per day, or as much of that. So that intrinsic value of storage becomes a really important part of the go forward. So with that being said, Edmund, I did want to toss to you here, and 200%, we're going to fall all the way down to 80%. Was there a magic number here? What do you see as possible, or what's the potential there?
Well, I think just a couple of quick observations on this one, just like the last one. They're pretty similar. I think this chart, this graph alone, is evidence of higher volatility ahead. End of story. How much more is needed? You can look at it a lot of different ways, both from a withdrawal standpoint and an injection standpoint, especially on the Gulf Coast. A lot of the LNG off-takers and marketers that are associated with the LNG volumes are looking for more injection for demand-related events. And then that's on kind of more of a macro, event timeline. The renewables that we're going to talk about, the renewables penetration, is driving the need for both injection and withdrawal for quick cycling intraday, which doesn't show up in really any of the gas data, which is really daily data. Totally agree. Extrinsic value is becoming a larger and larger part of the value. And I would say that because of the intraday volatility, the spot to futures volatility, next day gas to futures spreads, the volatility in those spreads, the structural nature of the market with LNG, with supply coming in from the Permian into a very constrained area with very chunky demand that supply is dependent on, is going to create more volatility in the future. I don't think there's any one right way to look at gas storage, like how much more we need. I think this is certainly the way we look at it. We also look at it as injection compared to daily flows. EQT has a really good graph in their current investor deck, slide 29, specifically that shows days of demand cover. And they show days of working gas demand cover across the U.S. going from 40 days in 2008 down to 25. So we're on that basis, we're at the lowest amount of gas storage ever for this market. You know, a lot of focus every week on gas storage inventories. Are we high or low relative to the 5-year average? Well, that doesn't take into account the fact that the U.S. market is now integrated into the global gas market. And I think those kind of perspectives are going to be talked about more and more. And, you know, if we're at a 5-year high, what does that really mean when you're tied to Europe and Asia demand and pricing?
Yeah, good point. And Edmund, I had forgotten to mention that too, that, you know, when you look at that purple line, and it speaks to the demand days, the EQT slide that you talked about. But when you look at that purple line, you know, we're at 110% in the South Central region and you know, it's equivalent sort of percentage in the overall US. That's well below where we were in 2005. So we're already in uncharted territories with respect to our ability to adapt to fluctuations in the market. So we've shifted, you know, below where the market incentive was back then to start to drive additional storage. When you look at LNG growth and that LNG growth going forward, I won't spend a lot of time on this, but I did want to put the facilities in here that we project going forward. You know, one of the big assumptions on this, and you know, we not only include FID facilities, and you can see the list here. We also include some non-FID ones, which we expect, like Delphin and Commonwealth and other ones that we expect to come into the fold. At the end of the day, I think as we cover this, you're going to see that even with the FID facilities, we're already in uncharted territories. You know, maybe with these non-FID, we don't need the tier 2 basins to come in as quickly, but we still need the responsiveness from storage. One of the big assumptions is you run this sort of at base load, because what is the volatility of these things going forward? We run it at about 90% of capacity, but on a daily basis or weekly basis, is that really true? Is that a good way to think about the volatility and to value the potential optionality of highly flexible storage going forward? I'd argue not. If you look at, these are the daily nominations from the facilities that we have in service today. And obviously we've had a lot going on in the last year with Sabine going down and Freeport going down for an extended period of time. You know, that in and of itself created volatility. If you look at the chart on the table on the top left-hand side, in 2019, we had a base load average LNG load of about 5.7 BCF per day. In that time period, we had 50 days or almost 50 days, 48 to be exact, where you had over a half a BCF of daily fluctuations, of a daily fluctuation in LNG demand load. Fast forward to 2022, we have twice the load, 11.8 Bs, and twice the number of days. So almost 100 days, or over 100 days, in fact, where we had demand fluctuations of greater than half a B, and of course, some days even more than that, 2 and 3 Bs. And so as we doubled the load, we also doubled the number of days to almost 3 months out of the year. The market was adjusting to more than a half a BCF disappearing. To put that into some perspective, the average storage facility in the South Central region, I didn't do salt versus non-salt, and there's definitely some differences there. But just the average facility in the region can withdraw about half a B. As Edmund suggested before, in many cases, these facilities can actually inject less than they can withdraw. So in reality, it's probably less than a half a B in terms of and maybe as much as half as much, like 250 a day. So when you put that in perspective of a half a B facility or half a B change in daily nominations, we're talking about taking a whole storage facility basically offline. I know it doesn't work that way, and the market pushes stuff around, which is the beautiful thing about the U.S. gas market and how it adapts. But just from a perspective standpoint, you're taking a whole facility offline. If you have let's say a 2 BCF fluctuation, you're taking 4 storage facilities offline essentially, or making them less effective in terms of managing other types of supply or demand variations that exist for the market. So it's not exactly base load, and certainly the volatility has been in their past. And as we grow from 11.8 to 20 to possibly 30 Bs of LNG, we're talking about tripling the number of days or tripling the magnitude potentially of the outages, which is the next topic we're gonna jump into here. Event-driven outages. So hurricanes are the primary focus of this. And I've graphed the hurricane path there, courtesy of NOAA, over 2020 and 2021 against that LNG Daley nomination. So you can see Laura that came through had a big drop in almost 2 Bs or over 2 Bs, a drop in the nominations that lasted for a number period of days. You had Sally, a 4 BCF drop in nominations, lasted for several period of days. Delta, similar. Zeta, a little less pronounced. Ida, you had about a B, a little more than a B in terms of shifts. So the interesting component of this, if we start to scale this up, is how is the market going to respond if we have a major hurricane come through and you have, let's say, 20 Bs of LNG facilities which aren't processing nor off-taking LNG load. Now the market has to absorb that gas. If it's 20 Bs, we're absorbing an excessive amount of gas into the pipeline grid, into the storage grid, and trying to adapt. That level of volatility is not just a rare, this isn't a 10-year event, like once every 10 years is going to happen. This is something we could deal with and face every single year. And this is not just, I showed hurricanes as a major event, but I mean, what about, we had Uri, which was a massive event in the market. It creates a similar sort of load dynamic that massively changes how the market operates. It changes basis spreads. It changes outright pricing, just massive fluctuations. If we put it in perspective of just storage and how storage in the South Central region operates, on average, the South Central region fills to about 1.22 TCF. Historically, it gets to about 1.37. So that's sort of the historical max that we've seen. Certainly, theoretically, it could get higher, but the historical max we've seen is at 1.37. That means that there's about 150 days or 150 BCF, of potential flexibility in the market. Well, if we have 20 Bs, let's say just in Louisiana, it could be home to 23 BCF per day of LNG offtake. Given that, hurricanes typically come in the September-ish end of season time period when storage is already at its fullest and injectability will likely be at its lowest. Because again, if you think of a storage facility, the more full it gets, the harder it is to put more gas in. And the lower those injections can drop. So we're at the time of the year when storage is the least flexible. We have a hurricane, which is, could happen any given year. It would only take 6.5 days of that 23 BCF being offline to completely fill all storage in the South Central region and leave the market, basically operationally handicapped in order to adapt to those fluctuations in the market. So I don't know exactly what the right level of storage is, but 6.5 Bs a day or 6.5 days seems to me that, if we were to run a stress test, like stress tests have been talked about in the banking sector and whatnot. If we run a stress test on the grid, which is actually something East Daley's working on right now, and you can see that in the bottom there, and give me a call if you're interested. But if we run a stress test on the Gulf and infrastructure and its ability to adapt to those kind of event-driven market events, to me, it breaks every time. The system will fail. And I'm not an overly dramatic person, generally speaking. I like to talk and I like to be excited about things, but I'm not generally overly dramatic. To me, this is an event we're going to deal with every year. This is an event we should be baking into forecasts. These are things that are going to exist going forward. if we do not have more storage and more ways to flexibly adapt to these types of events. So I'm going to stop there for a second. And I don't know, Edmund, you might have some comments on this and can maybe take us into some more of an even granular look at the types of events that could happen on any given day. But to me, this is a big deal, and the market is not ready to absorb these types of things going forward.
Yeah, I mean, just on the amount of storage that needs to be built. I mean, you can look at it a lot of different ways. I think whatever way you come up with, if you want to have the same level of volatility that we've had over the last decade, you need to build hundreds of BCF. How that gets done, I'm not exactly sure, but one way it gets done is through price signals. And, to your comment about the market breaks, I mean, some things, I mean, the way it doesn't break, the way our market is designed, luckily, is it's free market, and price floats, and price will go wherever it needs to go to shut off supply or demand. So again, I think this just speaks to more volatility ahead. We're going to go through periods where, like now, where volatility is low, it cycles low. It always cycles. At the beginning of the last storage cycle in 2000, gas went from $2 to something like $5, and everybody freaked out, and then it fell back, and everybody said, oh, it's never going to happen again. And then it actually went backwardated. And I remember that well because we had just started a storage company, and the screen was backwardated, and people said, we'll never need to build storage again. In fact, we need to get rid of storage. And we'll hear the same kind of things through this cycle. And then we'll see higher highs and volatility. So I think that's a great overview of some of the big macro, without even getting into global netback economics, which I don't pretend to, be an expert at or maybe even understand, but that also plays into this. I think if we go to the next slide, I can talk a little bit about what's going on just on a day-to-day basis, kind of underneath the gas data. So the chart on the left is ERCOT average generation fuel mix. And we picked 2007, that's kind of like the height of the last storage building boom. Coal was 51% of the actual, so this is actual, not installed dispatch stack. Coal's 51%, 45% was gas, and believe it or not, wind was 3% of actual generation in ERCOT in 2007. So fast forward to today, last 12 months data for ERCOT, we've got almost a 1,400% increase in actual generation from wind and now solar, and solar is really growing. A 41% increase in gas-fired generation, and coal, of course, is retiring. So what does that mean for today? So, and we'll talk about, big events in a minute, but what that means is gas has to fill not only the gap left by coal, but the gap left by wind and solar when wind and solar don't show up on a daily or even hourly basis. So, if you look at the actual fuel burn, 45% to right now 45%, what's the big deal? Well, the big deal happens in the very, very short term. And then we're going to take solar and wind even higher. So the last bar is an estimate of 2025 using the current ERCOT Q. And this is kind of really maybe a little early because there's a lot of things that aren't in the queue that probably will be very very soon after the IRA passed. And we're going to take that even higher. So gas is going to have to fill an even bigger gap. And then if we look at the graph on the top, on the right-hand side, what this is a snapshot of June actual natural gas burn in ERCOT versus 2007. 2007 is in blue, and it's basically a pretty regular up and down through the day generation cycle. Fast forward to today, it's much more regular. Wind and solar are pushing gas on the margin out to, on a typical day, the early morning hours of the day when wind dies and solar hasn't started, to the afternoon when we hit full load and we need everything on, basically. And then if wind and solar aren't there, gas has got to fill the entire gap again, like we saw this year in the later part of June. And then the bottom graph is volatile days over the last 5 years. And the purpose of this graph is to show that trough to peak in the gas market occurs over a very short period of time of the day. It's not irregular, it's not predictable. And the gas market, the gas pipelines are not built to flex, all the daily requirements of a peaker over an 8-hour period, and then to put it all back. When there's excess capacity, they can do that with line pack, but the pipelines will tell you there's less and less, and in some places, no more line pack to do that, and they're enforcing operational flow orders when things get too out of balance. So what makes up for that? Well, you either don't run, or you need storage, or you just take the penalties on the pipeline if they'll let you do that. So that's, we can go to the next one. And then this is more of an event slide. This is shamelessly borrowed from one of Kinder Morgan's earnings presentations. Kinder Morgan's had a lot of good information on storage over the last year in their earnings decks. This shows what happened in ERCOT during Uri. And basically the storage is saying gas had to fill the entire gap. And this happens every time we get a really cold major storm in Texas and the wind stops blowing or the windmills freeze and there's no solar. Same thing for heat waves. The wind and the solar, believe it or not, are not always there. And that story just keeps continuing. And the IRA bill just, it's just more of that. So, we're just, in some ways, we're just getting started on the intraday volatility.
Yeah, I sort of think about, Edmund, just to layer into that, or maybe a question for you. And storage, you used to look at these summer winter spreads, and you used to value storage, on that intrinsic basis. But then thinking through these event-driven instances, whether it be Uri, whether it be hurricanes, or whether it even being, maybe smaller events like managing the daily volatility of the renewable grid, you have to think about a completely different way. It's not a different way from what we've done before, but the mindset has to change, that the value you get from storage, like one of these events could probably pay the entire year's worth of storage rates that you might pay. That could happen over the course of a couple of days. As we've seen, as we model a lot of, we model the midstream companies, and many of those companies, as we saw with Uri and as we saw with other events, were able to and I say capitalize, they're positioning their assets were helpful in the market when prices peaked and things got out of whack. And they were able to leverage those assets to pay for the investments they've made, along the way in a single event.
That's right. I mean, traditional storage valuation models don't really include all that, nor do they include cash to futures value. It's more of a futures to futures valuation with historical volatility. I think we're going to look back in a couple of years and say, using historical volatility in 2023 was really, really being super conservative and didn't capture what's the fundamentals going forward. Those models also don't include the spark spread value to be captured when gas goes intraday from $200 per megawatt to $1,000. And do you have the flexibility to provide generation across that very short time window to capture that? So I think what we're going to end up seeing is a lot more sophistication in the models. I think we're going to see some more products being offered using flex capacity for both power and the gas market, and just more integration between the two markets in general.
Well, and the value, and it sort of ties into our next slide is I pulled, what I wanted to look at was the revenue, the rise in revenue from storage, and it is clearly on the rise. So over the last 5 years, this is FERC regulated facilities. So this does not include all facilities in the US, but simply the ones that are FERC regulated and reported through FERC, through some of our data dashboards. But that's been up from 500 million to 700 million. So almost in the last 5 years. So 40% rise in the value of storage. And certainly it's coming off of a bottom, as we talked about earlier, where, while the contracted capacity, which you can see in blue, has remained flat, just the value that the market associated to storage wasn't as high, after, sort of that 2000, as the shale grew in the late 2010s, 13s, 12s, period. That value started to drop, and rates that the market was willing to pay for storage started to come down for sure. And now we're seeing some of that slip back in as we see total valuations go up. And then as we narrow that into the Gulf, let's say, and facilities that we see predominantly Gulf. So this graph shows both contracted capacity on the right, these graphs, as well as storage revenue, and you can see the same trend where it's a relatively flat contracting, meaning the facilities have remained heavily contracted over the course of time, but revenue is starting to rise, and that's indicative of rates starting to rise and therefore driving more revenue. And what again that suggests is that we're in the very early stages of that realization of the value and the potential usage of storage going forward into the future. Again, these are Gulf type facilities. Many of these storage facilities are operated by major pipelines that cross regional grids. So like, for instance, I put Transco in here. Transco has about half of their storage up in the Northeast and about half in the Gulf. So this isn't just representative of necessarily just the Gulf. They've likely had uplift in the Northeast, but I think the story is still telling as you see that compared to the overall U.S. The Gulf is clearly on the rise, and I think a big component of that will be highly flexible storage facilities that are able to adapt to those market dynamics going forward. You can dig in one level deeper. This is just an example, and I think Edmund pointed out to me that it might underrepresent what's actually going on, which I agree with. But this is Egan, and their transactional reporting shows that their contract with Sabine had a step up where it moved from 8 cents to 18 cents. In April 1st, 2023, and for the next 3 years. But we see, this is just an example of step ups and the increasing value and the valuation that the market's starting to place on storage. because you can see the same thing in other storage facilities. I was looking at some contracts from Trace Palacios that are around 33 cents. So there's definitely some different valuation, and each storage facility has its own value proposition and as Edmund said, it's services that it's offering. So just giving some sort of a feeling for that directional trend that the market is taking.
Yeah, just distinction I'd like to point out on the data, like you mentioned, these are FERC reported revenues. So these are primarily regulated rate facilities. So the change from 17 to 23, and if you went back even further, wouldn't be all that dramatic. But what it doesn't include, especially relevant for Texas, it doesn't include intrastate storage. Mm-hmm. It doesn't include services that are bundled to include storage and transport, intra or interstate, I believe. And a lot of value is changing hands there. And it doesn't include, or maybe it does include, but it's a very small percentage of the total market, merchant market-based rate facilities. And if you looked at just merchant market-based rate facilities, whether it's salt or reservoir, and you went back to like 2010, or take it back to 2007, and you looked at how those revenues changed on a per unit of capacity, storage capacity. Again, unregulated facilities. Not cost of service facilities. Those facilities are going out into the market every year, every 2 years, and recontracting at new rates. Those rates went dramatically down. You mentioned Trace Palacios in 2014. Those rates would have been sub a nickel for the same capacity. Those are the kind of bids people are getting. The regulated cost of service facilities, they're good. They've got their regulated rate. But the merchant facilities went dramatically down. That's the market saying we don't need more storage. We're good. Like we talked about, shale. We didn't have LNG. We didn't have the renewables penetration we have now. That's changing. Uri happened, changed the market for storage rates across the United States. And now we're going to change the fundamentals even more. And that's all baked in.
Yeah, so I'm gonna slide 18. If you're interested in some of the recent transactions, dig through slide 18. I'm not going to. We're running short on time here, and I want to make sure that Gary and Edmund have some. They have some more slides here, so I'm going to skip this, and I'm going to toss it here. But check this out later. I'm going to toss it here to Gary to chime in on some of the regulatory environment and some of the things that are happening there.
Thanks, Justin. So I guess what I take from what has preceded me is a new wave is coming. And so we thought we'd level set here with just going back to look at the EIA working gas data. Justin discussed a different measure of the capacity of the storage facilities in the country. So this is their working gas capacity as reported to EIA. You'll see, consistent with what Justin described about their withdrawal capacity, it really hasn't increased much for that 13-year period or whatever, gone up about 10% over that period. Most of that increase is from salt dome storage. Again, I think that's a reflection of what the market is valuing in that decade, as opposed to maybe the prior decade when it was the more traditional depleted reservoir type storage, which might have been seeing an increase. On this next slide, I'll just talk briefly about what the regulatory process is that would face these projects as they move forward to respond to what is this growing demand for storage in the country. At ARBO, we help our customers understand regulatory risk to both projects that they may be investing in, as well as those that just may move the markets. I think Justin has made a pretty strong case that there will be either with or without storage projects, there will be movements in the market. So our focus is primarily on the FERC-regulated pipeline industry, where there was tremendous growth over the last decade. But the same regulatory process essentially applies to storage to the extent it is regulated as an interstate storage facility. Edmund mentioned this a little bit in his previous remarks. There is a difference in the regulatory structure between an intrastate facility and an interstate facility, much like there is in the pipelines. If you're familiar with pipelines in Texas, there are almost all, I think all of those pipelines that Justin showed on the very first slide are all intrastate Texas pipelines. So they're not regulated by FERC, they're regulated by the Texas Railroad Commission. Same sort of split occurs between storage fields and between being regulated by the state or being regulated by FERC. The distinction between what type of field is going to be regulated by FERC and regulated by a state entity could be a webinar unto itself. But I would say it's essentially a choice by the developer of the facility as to how they want to structure both their corporate ownership interest and the services they want to provide. And that will dictate what type of regulation they're going to be subjected to. But they will be subject to regulation. It's just a question of by the FERC or by somebody else. When you look across the country, the FERC-regulated storage fields are the predominant type of regulated fields, both as a measure of the number of fields and by the working gas capacity. So our data for FERC pipelines and for FERC storage goes back to 2007. Most of this next slide shows sort of the historic timing for how long it takes a storage project, a storage expansion project, to move through the FERC regulatory process. I would caution you that most, I think, as Justin has shown on earlier slides, most of the storage expansion occurred what I would call pre-2014, which is in the good old days. Beginning in about 2014, the Keep It in the Ground movement really got organized in opposing pipeline projects. So there haven't been a lot of storage projects that have been run through FERC post-2014. But even on those, I would say the timeline for a storage project is much quicker than for a pipeline project. If we showed you this similar bar chart for pipeline projects, even over the same time period, they would be much longer for the pipeline projects than they are for the storage projects. So of course, the timing is one of the factors that any developer will take into account, and we can help you understand the timing that might apply by region, or by what type of environmental review is conducted. I'll have to say, again, almost all of these storage projects, the type of environmental review was an environmental assessment, not a full environmental impact statement. And that's why you can get that environmental review period lasting less than 5 months. The most recently approved project, Sempra's LA Storage, which is not located in Los Angeles, but the LA apparently stands for Louisiana, got caught up in what we call the Glick problem. Former Chairman Glick pretty much revoked FERC's staff's authority to determine the proper level of review and began requiring an EIS, the full version of the environmental report for all projects. primarily because of his views on climate change. And so, you know, that LA Storage, Hackberry, Sempra, whatever project you want to assign its name to, went through a full EIS, and it took much longer than these timelines would indicate. But when Chairman Glick's nomination or renomination was blocked by Senator Manchin, the current acting Chairman Phillips replaced him. Our analysis, certainly of the pipeline projects, is that Chairman Phillips has returned authority to the FERC staff to make the decision on what proper level review should be given to a project. And so we would expect timelines in the future to return to what we would call normal length experience during the Obama administration. One warning, I guess, about, if we go back to the previous slide, one warning, I guess, is, you know, I mentioned Chairman Glick was very interested in climate change and greenhouse gases. Chairman Phillips has moved away from that and appears to be taking a more balanced approach. Again, more consistent with probably what Democrats would have done during the Obama administration. But he has announced that a key concern of his is the environmental justice issues raised by the infrastructure that FERC approves. Again, LA Storage, one of the few projects that has moved through FERC and got approved during Chairman Phillips's tenure. They agreed to or had imposed on them a number of conditions in their certificate that were designed to mitigate environmental justice concerns. So, you know, that may be a topic that a developer may factor into their decision as to whether they want to be regulated by FERC or the state regulator in the state in which they are developing it. I mean, that will be a problem because obviously the geology sort of dictates where you can put these projects. And so it will really be probably not a question of whether FERC will use that as a way to deny the project, but will create conditions about the above ground facilities and the impacts on those environmental justice communities. So I think I'll turn it back to Edmund. I think he's got the next few slides. And so Edmund, if you want to start on the considerations that developers like yourself might take into account other than my regulatory boring stuff. So,
well, yeah, I mean, they're all related. It's certainly a consideration that a developer has as regulatory. I mean, and you can look at these developer considerations also as constraints on new supply. I mean, that's really what they are. I'll just kind of tick through them. I mean, we could do a whole webinar on these alone, but we're coming up on the hour, and I want to talk about my project a little bit. Obviously, the market, where's storage needed, supply and demand, market comps, all those good things. The kinds of customers they're looking for storage, how urgently they need it, credit quality, future demand. To us, the Gulf Coast, as we talked about through most of this presentation, is the place to be. Geology. You got to have the right geology. They're not making geology anymore, at least not on a time frame that is relevant to all of us. And geology is limited. So whether it's a reservoir, and I've worked on reservoir storage projects, and they can be, let's say, put it mildly, challenging, complex, can take years to fully understand what you have there. Salt is a lot more straightforward. You need high quality salt. You need it in the right place. You need the right size. You need the right depth. That all those factors drive cost, compression, surface pipelines. What are the alternatives in the market? Is storage full? Are there lots of salt domes around you, or not really any good ones left? Land access, mineral rights, water rights for salt is a big issue. You need the right amount of water supply and rate to leach a cavern, to wash out a cavern. You also need brine disposal to put that water away in the same quantity and at the same rate. Putting all those things together is challenging. Regulatory, construction costs, obviously, and then expertise. Do you have the expertise in the particular kind of field and market that you're working in? A little bit about our project, and considering all those things, we go to the next slide. We have a salt dome project in Fort Bend County, Texas. It's about 25 miles northwest of Freeport LNG. We'll connect to Coastal Bend Header, FGT, Kinder Tejas, Texas Eastern, Transco, Tennessee, Matterhorn Express out of the Permian, Enterprise and Energy Transfer. Some of those pipelines are closer than others. Coastal Bend Header, Gulf South Coastal Bend Header is one of the close ones. We're about 6 miles away from Coastal Bend Header that goes directly into Freeport LNG. We get asked a lot, how is it that you guys found the salt dome and got control over it when we didn't? And the answer to that is this project started 5 years ago with the intention to develop for other markets, not gas storage. And if we were to go out today and try to get control over one of these things, it'd be probably a lot more difficult. Fast forward to today, the gas storage market needs more capacity. It's a well-developed market. That's not to say that we couldn't provide storage with some of the dome that we control for hydrogen storage, and we're talking to a number of folks about hydrogen storage. You could also use it for NGL storage, crude storage, anything. So we're very excited about the project. We've scoped out a phase 1 of 16 BCF of working gas, 10 cycle type storage. Interconnects will vary based on market demand. We're currently negotiating with anchor shippers to sign preceding agreements. And we just kicked off a formal equity raise process with Jefferies last week. So people are interested in investing in storage, contact me, and I can put you in touch with Jefferies. The bottom line is, for all the reasons we discussed, we're very bullish on storage. This country needs, and this region in particular, needs a lot more storage for all sorts of reasons. There's not a lot of supply, and if you've got storage under contract at good rates and you have extension rights, I think you're going to be extremely pleased going forward. So that's all I got. Maybe just one more slide. The last slide is just a little bit about the team at Gulf Coast Midstream. We've got, if you go to the next slide, Justin. The team has worked on over 20 gas source facilities, either in development or operation or commercialization or all the above. 150 years of combined industry experience. So we feel like we got the right team, we got the right salt dome in the right markets, right time. So it's been a pleasure to be on this webinar with you guys.
Amen.
Well, seeing as how we still have a bunch of people still on, if you guys can hang on for just a minute, we'll try to answer some of these questions. There's a flood of them that come in, so I don't know that we're going to get to all of them, but we'll certainly try to answer some of them. To the extent, you guys appreciate you being on this webinar. ARBO has a free, check them out on LinkedIn. They've got some stuff. It's good to follow, see some of the regulatory stuff. East Daley's got a daily note. Hit that QR code. It's a free note. It comes out, daily, as the title suggests. So we've got some interesting stuff to deep dive. So please check that out. I'm going to take the first one, guys. If you want to peruse through a couple of those, Edmund, I think I saw some on, and as well as Gary on the constraints to building out. But just a couple of notes I saw on data and information in this that I think are helpful. From an LNG standpoint, I see a few questions on that. We see about 11.4 BCF per day this year, 12.4 next year, and that steps up to, I believe, 15.2 by 2025. That step up is largely a function of we roll in Golden Pass and Plaquemines in terms of how much demand they have, and that could certainly be front weighted, as we're hearing from them that they can actually take more sooner. So we may be even a little slow on that uptick. Nevertheless, then there's a big sort of lull in 25. So therefore, we from our perspective, we got plenty of supply and in fact, we've got some issues with basis constraints and basis issues that are worth talking about that we didn't have time to cover today. There's also a question about how much we bake those in at 90% of capacity, understanding that some of the ones that were FID'd, like for instance, I don't know, like Cheniere's Corpus Christi is only 83% SPAs and contracted, and Sempra's Port Arthur is 78%, I believe. So they got FID. They're not quite at that 90% level, but that's how we're baking in the expectation of the load off of them. So it certainly could mean that there's a little bit of a less load to the extent that those things don't run as highly utilized as we have built into that 90% forecast. Nevertheless, I still think the volatility, whether it's 20 Bs or whether it's 19 Bs of load, the volatility is still there to drive, further additional need for storage. The other thing, just a quick comment, and then maybe Edmund, I think there was one at the end, on rates and some of the challenges there that you can jump into. But the other thing on supply from tier 2 basins that somebody asked about is there going to be a massive consolidation phase, leaving the best in class producers in control of the ramp up? I mean, we've certainly seen the consolidation. We've seen it in the Permian. That resulted in lower rig counts. Some of the drops that we've all noticed in the Permian are in fact consolidations of producers who have then reduced the number of rigs. So yes, as we see that consolidation, you could see some major players in charge of that ramp up. Nevertheless, there's still a lot of acreage out there, in my opinion, and I don't have numbers on this, but just from a perspective of Barnett and Anadarko and Eagle Ford, I think there's still a lot of acreage out there that's going to need to come into consideration, maybe not for the initial ramp, but for the longer term stability of supply for these pipelines. I think that you're going to need to pull in tier 2 that maybe not necessarily controlled by the big players. So Edmund, there's a question towards the end that I glanced at about hurdles and new facilities and rates. And I know you probably have a vested or very close to that subject as you try to bring your facility up online. So you want to take that question about, what are those challenges? Gary, you certainly can. I think you commented on some of that during your comments.
I'd say that, the hurdles are the development considerations we talked about. You've got to check all those boxes to have a project, and then you've got to have customers, and that gets to rates and the question of whether rates are where they need to be to justify new build costs. And we are right on the margin of that today. And we're negotiating with folks that see that value and can justify new build, and some can't yet. The way they're modeling it and their view of the fundamentals. We think that's going to change, and we're getting real close. But my personal view is that the market does need more storage for all the reasons we've discussed, and a lot of customers that can't get to the rates that justify new build economics will acknowledge that we need new storage. And so what has to give? And my view is that the market's going to work, and it's going to give us a price signal through volatility that justifies that storage. And a lot of it will get built, has to get built.
Okay. Just glancing through a couple more questions here, and then we'll probably take some of these questions offline because we've got more than we can answer here. But certainly, as I said, we will get back to you. I mean, there was a question about like mid-con storage and how does it play a role in other storage facilities. Listen, I think the whole grid does balance, right? Like that's the beauty of how the whole grid works. Where I get concerned, let's take the hurricane example for instance, is the major events. I don't know that the grid is capable, or I in fact will, through some analysis we're working on, which I suggested in a previous slide, that please let me know if you're interested. But if you just focus in and zero in on a very narrow portion of Louisiana, we're talking about putting 23 BCF of LNG facilities there. If you ran a stress test on that, I'm sure it would fail. And it would fail because at some level of that 23 BCF, when demand slips, the ability of the pipeline grid and the storage facilities in the area to balance that is going to break. And the question I always have is where do you need to develop new storage it's best positioned? And obviously Edmund talked about the geology. It doesn't, no one's inventing new geology. So that's a fact. But what connectivity needs to exist to create the most optimal, situation where we can balance? If there is geology, where can new storage facilities be developed or expanded and have the best opportunity to balance that? Is there more looping of pipelines and connectivity that needs to happen to balance that out? Because we're talking about very concentrated areas. By the way, concentrated areas in the case of Louisiana, that is in fact the home to Henry Hub, the benchmark pricing for the U.S. So you could certainly see massive fluctuations in Henry Hub spot pricing as you get events that dramatically impact the supply-demand balance in those regions. So yes, that's a long-winded answer saying yes, Mid-Con is part of the solution, and so is Northeast, and so are all the facilities. But at the end of the day, those are far away, and there's only so much pipe capacity to balance that. Okay, well, I think we're about 10 minutes, past where I think we wanted to end. I don't know, Edmund or Gary, if you guys have any closing comments, I think now's the time. I really appreciate the opportunity to present with you guys. It was fun. I'd love to do it again sometime. Please, I'll let you guys have the last word.
I'll go first, Edmund. I just want to thank you, Justin and East Daley, for inviting us. My contact information is on the slide. You already mentioned you can search for us, ARBO, on LinkedIn, and we do publish a bi-weekly newsletter. And then we also have a blog at goarbo.com, so where we cover all sorts of regulatory issues and events impacting energy infrastructure. So welcome any contact, any reach out people might have.
Edmund, send us home. Oh, I think he might have frozen. Oh, no. Well, thank you, Edmund. We appreciate you being here. Contact Edmund. I think, storage is valuable. So I think give them a reach out. They've got an interesting facility with some great connectivity. It speaks to a lot of that Eagle Ford, Permian, sort of combining the forces there. So please reach out to him if you have any questions about his facility and the operations and what they're doing down there in Texas. So thanks again, everybody. We will be in touch with regards to questions. We'll send out slides and recordings and all that fun stuff. So again, thank you. And we look forward to we'll talk to all of you again.
Thanks.